Hello and welcome to another Securities Lending Saturday. I'm Roy Zimmerhansl. I'm your host, and today we'll be doing the second of two segments on repo specifically, and then next week we'll be talking about a comparison between securities lending and repo. But today, part two of repos. So if securities finance is your space, whether you're a borrower, lender, market participant, structuring part of the universe, or you're just plain interested, then this is the place for you. So let's get started. Hi, everyone. Again, another Saturday, another dreary and a little bit cold Saturday here in the UK, but we've got lots to energize us with today. As I said, we're going to be talking about repos today. It's a continuation of last week's event. Last week, we talked about a little bit more of a macro view and sort of high level discussions. We'll be getting a little bit more detailed today. And then next week, what we'll be doing is taking the comparison of repo and securities lending and do a little bit of a compare and contrast. So without any further ado, let's get started. I've always got a slide deck. That's it. That's today's. Don't forget that if you are interested in getting the slides from the show, you just need to go to this spot over there in the corner and sign up for that. And then over the course of the coming days, we'll send you the slides from the entire series, not just today. If you want to see this, if you're watching it live on LinkedIn, thanks very much for joining. Of course, at the end of every live episode, I cut it back to 10 minutes on LinkedIn because it's not really a great place to store things. It's great to reach a really wide audience, so I appreciate that, but it's not great after the event to be able to locate it. So we put it onto our YouTube channel. We edit it. Tomorrow, Sunday, it'll be available at 3 p.m. UK time. And the YouTube channel for all of the videos is in the bottom corner there. So have a look at that. Otherwise, just go to YouTube and look up Roy Zimmerhansl. There's not a lot of us on YouTube named Roy Zimmerhansl. Nilesh, good to see you. Hi. Thanks for joining us again. If anyone else is out there, tell me your name and who you are and where you are watching from. In the meantime, let's get going. This is what we've been talking about over the past 39 episodes. So we've covered pretty much everything. Every time I think we've covered everything, I realize that we haven't covered everything. And that's a good thing because otherwise I wouldn't have anything else to say, would I? And that would be the end of this. And that would give me a whole bunch of time on a Saturday, which what would I do with time on a Saturday when I could do securities lending instead? So let's get to it. What we're going to talk about today is, you just have to excuse me for a second. Sorry about that. We'll go through a bit of a definition because I realized that in last week's episode, I didn't actually do a definition or a general explanation. I talked about it, but I didn't specifically write anything up. So we'll do that today. We'll talk a little bit again about the purposes and motivations behind doing it, a little bit about haircut factors. So what goes into the thinking about which collateral you're willing to take and how much excess collateral you are willing to take or you need to take in order to be coaxed into doing a transaction. We'll go through a very simple financing example for a repo transaction. And then we'll talk more about the repo flows, reverse repo flows, and yield enhancement. So that's on the agenda today. Don't forget, if you have questions along the way, feel free to put them in. This is usually where I make the pitch to say, let's get to 500. We're past 500. We're at 507. So thank you very much, everyone that has subscribed. And thanks to the 10 or so people that have subscribed in the past week. That takes us over the 500 level where YouTube is supposed to enable the channel to have a community channel. which means that we can put questions and answers and have more of a community discussion in there. They haven't enabled that yet. Apparently, I've done some research. Apparently, it takes about a week. I think I went over on Monday, possibly this past week. So they're still in the next couple of days. I would certainly hope by the middle of the coming week that the community channel will be open. If that's correct, then I will do a special episode this week to talk about what the community channel means to me and what it could mean to you. So thank you everyone for subscribing. The next channel, the next sort of hurdle is 1,000, but that's a ways away yet. So we won't even start talking about that. But again, thanks very much. And thanks for everyone that I know a bunch of you have introduced the channel to friends and they've subscribed. And I really appreciate that. So thanks for just simple definition, a sale and repurchase agreement, or otherwise known as a repo. It's a sale of securities, as the name suggests, and a repurchase in the future. So you're making really two commitments to trades at the same time, an opening leg and a closing leg. And it's a specified date, usually, although not always. There are open repos where it just keeps going until one or the other side cancels it, but that's very much the minority. Most of them have a fixed term. And although legal title to the bond is so if I borrow money from you and I give you my bond, that's your bond. You can do whatever you like with it until the end of the transaction where you have to give it back to me. But of course, I still keep all of the economic benefits of owning that bond that I have delivered to you. And of course, that means I also keep the risk. So we do that by mechanisms of, first of all, the agreement enforces it. And so it covers things like what happens if there's a coupon payment. In the daily margining, we actually look at the valuation fluctuations, and one party or the other might need to give more collateral or get some collateral back. And of course, in the end, the entity that is getting the cash, the borrower, of course, as any borrower would be paying an interest rate for that. They'd be paying interest on the money that they borrowed, and that's known as the repo rate. So that's a simple example or a simple definition of it. Typically, it's used for financing, although that's not the only reason. So what you have really is, on the one hand, you have cash-rich market investors, and on the other hand, you have securities holders, bond holders usually, and they want to actually borrow money against that. This concept, from a trading book point of view, you either are long a bond, you own a bond, so you're long that bond, which means you're short of cash because you had to give cash to get that bond, or you are long cash, which means you don't really have any securities because you haven't bought anything. So now you have cash and you can use that cash to get securities. So you're long cash. So you're either long securities or you're long cash. When we talk about being short securities or short cash in the context of positioning for repo, we aren't talking about taking an actual short position in that security. Just think of it as I always have either inventory, securities inventory, or I have cash. And if I have one, I don't have the other. Remember, this is on an individual case. So if I have 3 bonds and I have a bunch of cash, of course, overall, I have both. But for each of those individual bonds, I'm long the bond, short the cash that it costs me to buy them. Or if I have the cash, effectively, I'm short bonds. I don't have any securities in my portfolio. I just have cash for that one position. And then aggregated, of course, you're likely to have both. Legally, as we said, it's a sale and a repurchase. But of course, economically, it's really like cash lending. All right. And as we said, the cash investor, the flip side of the cash borrower, pays an interest rate. Cash investor, the cash deliverer, or the cash buy, or the bond receiver, all of those are interchangeable versions of the same entity. They're the ones that receive that interest rate payment. And for them, what it is, it's a secured loan. Just like when the bank lends you money for your apartment or flat or house or car, they take that asset as security, so that if you don't give the money back, they get to take whatever the asset is. And the same here. Of course, a cash investor could just leave a deposit in the bank and have bank exposure there, but of course that's unsecured, so they have to hope that the bank is continuing to operate. And that's why repo is a good alternative or complementary or a diversification from bank deposits, where in a bank deposit, it's counterparty exposure. In a repo transaction, of course, there's counterparty exposure, but your main protection is the asset that you're holding as collateral, the stocks or the bonds or whatever it is you receive as collateral. That is your primary protection. Sorry about my throat today. It seems to not wanting to cooperate very much. Okay, when we talk about the collateral that entities take, there are a number of things that you would consider about the type of collateral, but not just what type of collateral, but how much of that collateral you'd be willing to take. And here's a few of them. Of course, the rating of your counterparty is really important. I might be willing to take lower quality collateral from a better quality counterparty, because there I'm saying the likelihood of them going out of business, in my view, is very low. So I will take lower quality collateral, and maybe in exchange for that, I can charge them a higher fee. You want to look at the volatility of the asset that you're holding as collateral, of course. You want it to have some stability of collateral. Again, all of this is trade-offs. You can decide on any of these factors to be conservative, or you can be more aggressive, or of course, somewhere in between. And the impact of those decisions, or that view, or that perspective, is it impacts the price that you can receive if you are lending money. So if I'm going to take a more volatile asset, then my counterparty should be willing to pay me a higher fee, because fewer people are willing to take volatile assets. If I'm a low rated entity, maybe very few people would deal with me. So again, I have to pay a higher rate to access that cash. Then you get the normal issues. I mean, all of these you need to take into account in any kind of collateralized transaction. So you have your liquidity and concentration risk. Have you got an overwhelming proportion of the daily turnover in that asset? Because if your counterparty goes bust, you need to liquidate that asset. And if the market is too thin and you can't sell that asset, you now have market risk, market volatility on that asset until you can fully dispose of it. So that's your challenge. And that's what we talk about as being the risk horizon of the asset. Of course, you need pricing, and you also want to look at sort of the correlation. If all of my collateral is from the same issuer or the same country or the same region, I'm now exposed to specific company issues, of course, but also market issues. I don't really want to talk about current events at the moment, but you can see activity happening in a given country and how that means that any activity related to that country will be damaged by market events. Okay. There's also frequency of margining. So will you reset that on a daily basis so that any short-term fluctuations or volatility are corrected and the right entity is collateralized to the correct degree? And of course, the duration. How long is this transaction for? A 3 repo transaction has more inherent risk in it than a 1 week, and a 1 week has more risk than a 1 day. So that will have an impact on it and your overall portfolio approach, whether you're dealing on one single transaction with a customer or a counterparty, or if you have a multiple portfolio, and your rights to set those things off against each other. So those are the things that go into the haircut factors. If we look at a simple repo transaction here, what we have is a bank that is long the bond, which means that they're short the cash. We have a cash-rich investor sitting back looking at their screens, trying to figure out what they're going to do with that cash. And so they agree to transact. The bank wants to borrow $10 million. The repo rate for 30 days is 0.25%. And so the cash giver decides, well, they ask, what have you got as collateral? They show them what the collateral is. This is just a bond certificate from a corporate entity. Pulled out this typical margin guide, this median margin guide, which I showed in last week's episode, that came from the US report on repo activity. And it shows here that a corporate entity typically was at 5%. And so the margin here, I put in 10. In fact, I'm going to change that now. I'm going to change that. Hold on. I'm going to change that. I was looking at doing a different asset initially. And so I originally put in 108, and then I changed my mind. Do you know what? It's going to take too long for me to change it, so I will leave it. So this should be 10,500,000 worth of bonds being delivered to the cash investors. Again, the reality is it's whatever the two parties agree. So in this case, they might have agreed to take an 8% margin rather than the typical 5%, which was observed in the US. Because again, that's just the median level. What the median means that there are as many entities taking higher as there are taking lower. So there is a wide range there. It could easily be people taking 8% to get to that average of 5%, or at least that's my story. Okay, so they're taking a little bit of excess bonds. They've given them the $10 million cash, and this is on day zero, the opening leg. It's a 25 basis point repo rate. So that's 25 basis points per annum, not for the 30-day transaction that we have in the example. So this is the closing leg. So this is day 30. The bank that had borrowed the cash returns the cash. The cash investor that was holding the bonds as collateral returns the bonds as collateral. And the cash investor has earned $2,083. And you get that by calculating the 10 million of cash, the quarter of a basis point. This example, we're doing a 360-day calendar. It's a 30-day transaction. So that's your 2,000 of earning. It's a pretty straightforward calculation. It is just an interest charge for the amount that's valued, right? So that's the closing leg. Both sides end up with the original asset that they had. Okay, so that's the example. Let me talk a little bit about the 5 different flows as I describe them. Why people do repo trades. So again, this is where the bank is financing a long position. So they have an asset, they paid money for that asset, they want to get that cash back so that they can put it into their operating funds. That's how they fund the ongoing daily operation of their business. So you look at the securities inventory. In this case, those are examples of US Treasuries. The repo desk, they're now tasked to say, go out and find cash lenders that will finance those bonds. So we'll still own the bonds, but we will be able to get that cash and deploy it into our normal business. And that's really the primary role of financing a long position. The flip side here is that you've got a short position in the market. So the trader has actually taken a trading position in the market. They owe the bonds into the market. And so now they need to get the bonds to deliver. And in this case, they do that by going to the repo desk and saying, go use our cash, go use the firm's cash to get the bonds in from someone that actually holds them. We now have the bond. We can now deliver that bond and get our cash back. All right. So that's how you would finance a short position, maybe until the position gets closed out, or maybe someone has actually failed to deliver to you, in which case this is one of the ways you would access the bonds to be able to get them back to deliver into your market obligation. We talked about reverse repo. And of course, here, what we're talking about is someone reversing in a bond. In this case, the cash lender. So the repo desk goes to the treasury and says, if you have cash, I'd like to take that, lend it out to someone. I'll get their bonds as collateral. And that's my protection that the cash borrower will satisfy the closing leg of the transaction and will be holding collateral in the event that they don't. Now, of course, if we go back to what I said last week, although this is a repo transaction, right? The reality is this first one here is a repo transaction. From the cash investor's point of view, it's a repo, a reverse repo. So this cash investor is the same as the bank here, where they have cash they're putting it into the market and they're getting in bonds. So that's a reverse repo in this example, as I've described it. Okay. But it's really just the flip side of this transaction, this first one. Okay. So these are just interchangeable. It depends on your perspective. Then there's two ways that you can use your inventory to generate incremental returns. There might be from time to time a bond that you are holding that is very much in demand. It might be the cheapest to deliver bond as a result of a derivative transaction. So maybe into a bond future, it's determined that this particular bond is the right one to use to deliver into the market to satisfy that delivery obligation. So now that has a huge amount of value to anyone that's looking to obtain that cheapest to deliver bond. And so the repo desk will show that out to counterparties who say, yep, I need that bond for my business, and I will pay you. I would deliver you the cash, but I'll also pay you a fee for that because that asset is very valuable for me to get. So I need to obtain that bond. Or there might be other trading conditions that actually means that the bond has incremental value. So it's normal supply demand issues. This is what happened at times during quantitative easing over the last 15 years, where central banks in particular ended up buying so much or such a large proportion of bonds in issue on specific issues that when there was active trading going on in the market, they had cornered the supply of those bonds, and it impacted the settlement efficiency in the marketplace. There's also this last aspect where you talk about spread trading, or you can call it basis trading, where the repo desk is actually taking a view and trying to generate a profit by doing this kind of a trade. So what they're trying to do is raise cash from their inventory. Using their inventory of assets, they will use those bonds to borrow cash because the assets are like really widely available assets. They don't have to pay too high a rate because they're always substitutable. They've got a big enough inventory that if it's not that bond, it'll be that bond. The cash investor is now holding very liquid assets that they know that in the event the counterparty defaults, they can dispose of that. So they don't really need a high interest rate charge to compensate them for the risk that they're taking. And that repo desk, now having borrowed cash at one level, can now lend that cash out and get bonds as collateral back. And they might take credit risk. So that they might have loaned out a government bond, which is good quality collateral. So the cash investor will charge a low rate. And they might take a corporate bond as collateral. And there'll be a spread between what they can generate for financing a corporate bond versus what they can for a government bond. Or they might take market. And again, here it might be different durations of the transactions. So they could borrow money for 3 months in the repo transaction, this open leg here. And then on the reverse leg, where they're going to be taking bonds in, they might do a 6-month transaction. So they're getting a 6-month rate, but borrowing money for 3 months, which means, of course, they have to roll over that 3-month financing for another 3-month financing, or you can do the reverse as well. I'm borrowing money long term, and then I deploy it in the short term in the market because maybe I think interest rates in 3 months, so I've got one leg of the transaction, but I can get cheap 6-month money now. I might put something out in the market for 3 months, waiting for interest rates to go up. Then the next time that interest rates go up and I finance someone else's position, I'll make an even bigger spread. So that's a pretty simplistic couple of examples on how you can use it to generate profit. And the reality is not much of this stuff has really happened over the past period post-Lehman or post-global financial crisis, because interest rates are basically all flat. They were all zero or slightly positive or slightly negative. And so there wasn't really as much of an opportunity there. But in the same way that investors looking for a cash return would go potentially to emerging markets or lower quality corporate issues to generate that income, again, you have the same opportunity to do it with the repo trades. So that's it. This is a quick show because we were just doing sort of very simplistic examples. So we went through the definition, which is effectively a short-term transaction with transfer of title, where one entity is borrowing, the other entity obviously lending the cash, and it's secured by stocks, bonds, whatever they agree mutually between them. We talked about the reasons why people would do repo for financing reasons. We also talked about in the flow section about different ways of making money from doing repo trading, from starting an opening leg and then positioning yourself in the market to either take credit risk or market risk. We worked through an example of repo pricing. It's a really simple price. The one thing I didn't talk about is sell buybacks or buy sellbacks, where that same example of the money, this closing leg, if you did this transaction as a buy sell back, the same amount of cash borrowing or cash interest for the cash lender would be the same. It's just calculated differently because you're taking into account the closing price. You're building that $2,000 in to the closing transaction. The figure itself might be impacted if there's a coupon payment on the bond. So in a normal repo trade, while this bond is outstanding, so after the opening, let me go to that. So this bond has owned by the bank, delivered to the cash investor. If that bond pays a coupon during that period, right? Since this investor holds it, that cash payment is required to be passed straight through to the bank, directly or indirectly, so that the bank retains that kind of economic ownership. So if a coupon happens, it gets paid through. In the event it's done as a buy sell back, though, the coupon isn't moved until the end of the transaction. So that will have an impact on the closing price as well. But of course, you know that when you do this opening leg because of the bond that you are going to be doing, right? And it's not, and the difference is with repo trade, remember we talked about general collateral. So although we are talking about a specific bond here, it's possible that they have agreed that says, look, if this is a single A issuer of a bond that is dollar denominated and it has a 5-year maturity on it, they might have agreed. This cash investor says, well, if you need that bond back, then I just need another corporate that's A rated with a 5-year duration and dollar denominated. So it becomes substitutable. That's not the case with the buy sell back because it's just one entity is sold, the other one's bought, and that position stays through the rest of the transaction. Okay, generally. Of course, there's always exceptions to everything, but generally that's the case. Okay, so we talked about all of that. So that's the cash flows. Look, next week, what I really want to focus on is the differences between securities lending and repo, compare and contrast. Why would you use one transaction or do a transaction one way, or why would you do it the other way? That's what we'll be talking about. So that's it for possibly one of our shortest shows ever, half an hour, just over that. Thanks very much for joining me today. Happy Saturday. Have a great weekend. Have a great week. And I look forward to seeing you next weekend.